Welcome to our fourth quarter strategy review, which we held yesterday right here in this room. In attendance was Len Schill on my left, Vice President and CEO of the firm, and Bob Toomey on my right, who is the Director of Research and also a Vice President. Joining us by phone was Andy Leckel of Eagle Asset Management, and we thank Andy very much for his comments. It gives us more perspective on the entire investment scene. Our general comments from yesterday were lots of concerns about the buying on dips and people feeling uncomfortable with missing the market and what that really means. Is there some distribution going on? And that was an area that we discussed in some detail. We also discussed the concept of making sure that we had enough income in the portfolios for our clients to make sure that we could meet their short-term needs, especially considering the fact that we have such low interest rates, and therefore there was continuing discussion about where we get enough income, again, to offset those income needs, so that if we do run into a capital market decline, which of course is always a possibility, that we would not impact capital, that a lot of that money would be coming from income. So that was the general backdrop of the meeting. The overall was still to stay the course pretty much in the same vein as we are currently this quarter. We did raise a little bit more cash, but again, don't want anyone to feel like we were very concerned and very bearish. We were just cautious and making sure that we were doing the best job for our clients in terms of client preservation of capital. I'd like now to basically turn to Len to discuss specifically the international situation, which, as he will cover, is not quite as good as ours, but maybe better than a lot of people think. Len?
Thank you, Stan. As Stan said, we are looking at a situation where we're not completely negative by any means, but cautious is a better word. We're just looking at making sure that we're doing prudent investing for you and making sure that we're not taking unnecessary risks. When we look around at the rest of the international environment, there really aren't any places that stand out as places that are solid. The U.S. is growing and growing solidly and slowly, and Bob will talk about that in a little bit. But internationally, you've got Europe that is going through a very serious recession of their own at this point. You've got China that is in a forced slowdown. Emerging markets have been struggling for a little while and are starting to come out of where they were down a bit. And when we're looking for places to invest and places to allocate our international portion of your portfolio, we're looking right now at decreasing the allocation slightly to some of the more developed nations, places in Europe, places in Australia, and some of the larger developed nations. And then we're also looking at slightly increasing the allocation to the emerging markets, as we feel that they're at this point better positioned for a little bit of growth than the rest of the developed world. So with that, we've cut back on our total international allocation, but increased the weighting to emerging markets. To talk about what's going on with the U.S. stock market, I'd like to turn things over to Bob. Bob?
Thanks so much, Len. I want to follow up a little bit on Stan's comments. And as he mentioned, this was a very interesting meeting. We spent quite a bit of time discussing valuation, discussing where this market has come from. As you're all well aware, we're now past 5 years of a major bull market. And it's interesting because a lot of people are still doubters about this market. But when we look at, we're cautious about a number of things. First, valuation has come up significantly. We're now trading at around 17 times forward earnings. That is not what I'd call excessively high valuation, but we're no longer down in the 10 or 12 range that we were several years ago. And we think that the market is a little bit extended in the short term. We're also a little bit concerned about sentiment. We see that a lot of institutional strategists are very bullish. In fact, the Wall Street Journal had an article this past Monday that talked about the three remaining bearish strategists on Wall Street just recently threw in the towel and have now all turned bullish. That was a little bit of, again, a concern for us. And there are also some other strategists out there who we have a very high regard for, who I think feel the same way we do as a firm, that while we're very positive about the long term, we are concerned about some of the near-term sentiment and technical indicators that we think have increased the probability of some sort of correction. And as a result of that, we have nudged back our equity exposure, as Stan mentioned, as a way of prudent capital management. I will say that with respect to the offsets to these negatives, corporate cash is still at extremely high levels, and the level of ownership on the part of individual investors still remains at a 15-year low. So there are still very positive long-term secular trends that cause us to remain, quite positive about the long term. So with that, I'd like to turn it back to Len to discuss a little bit about our fixed income strategy.
Thank you, Bob. With respect to bonds, we've been discussing with you for quite some time the conundrum that exists with such very, very low interest rates, and the idea that interest rates really have almost nowhere to go but up. They're historically at extremely low levels right now. And we're trying to make sure we find appropriate places to get income in your portfolio without leaving you susceptible to the adjustment in bond values that is going to occur when interest rates do go up. For now, we've got a situation where while U.S. interest rates are remarkably low, the rest of the world is even lower. Europe has remarkably low interest rates, especially considering some of the financial crisis that it's been through and some of the issues that are involved with anybody investing in those particular countries. So we at this point don't see a situation where there's going to be an enormous amount of demand for interest rates to spike up in the United States. The rest of the world is providing absolutely no reason for interest rates to go up higher in the US. The Fed is going to continue with its policy of buying fewer and fewer of the mortgage-backed securities that they have been doing. The quantitative easing is going to continue to taper, and they are going to continue with the policy that they have put in place. As they do that, we do expect interest rates to slowly rise. We don't expect large spikes, but we expect them to just kind of gradually move up. When that happens, bond holdings will get affected by that, and so we are looking at a number of bond substitutes to investing in traditional U.S. Treasuries so as to try to provide the necessary income in your portfolio during this period of low interest rates while also not leaving you susceptible to that interest rate risk that we see coming. We're using utility stocks, we are using emerging market bonds, and we continue to use things like corporate bonds rather than treasuries, and as well as some high yield bonds as well. With that, I'd like to turn it over to Bob to discuss some of the changes that we've made to our model for this quarter.
Great, thanks so much, Len. So with respect to the investments in your portfolios, in a general sense, we did slightly increase our exposure to large cap equities. The reason for that is because we continue to feel that U.S. large caps are both positioned to benefit from both a relatively strong U.S. economy and also best positioned to capture global growth outside the United States and translate that into rising sales, earnings, and dividends. So we We continue to favor quality, large cap stocks that pay dividends with a more of an emphasis on companies that can actually pay rising dividends. We continue to like exposure to healthcare because we think there are very positive secular growth trends in that area. And also technology. We believe that the large U.S. technology companies are very well positioned for global growth and continue to offer, with respect to valuations and very strong free cash flow, these types of stocks continue to offer, we think, a very attractive relative risk reward. In the area of developing equities, which includes mid-cap and small cap, we maintained a stable exposure there. We really didn't change that at all. We feel that it's important to have exposure to these areas with respect to long-term growth. However, relative valuations for small and mid caps have really risen over the past couple of years. And again, we think on a relative valuation basis that large cap stocks offer a somewhat better value at this point, and that's part of the reason for our emphasis there. With respect to real estate and natural resources, we remained essentially stable in those areas. We do think that REITs recently have pulled back a little bit. We think because of concerns over rising interest rates, but given our long-term outlook for interest rates, of moderate increase and a good growing U.S. economy, we think that this is a buying opportunity in REITs, which should do very well as our economy improves. In the area of natural resources, we also continue to maintain our exposures largely in the energy sector, U.S. petrochemical and chemicals, and forest products. And with that, I will turn it back to Stan for some wrap-up comments.
Thanks, Bob. And thanks to Len, and also, again, thanks to Andy. It was a very interesting meeting. It was a little longer, frankly, than it usually goes, because there were so many areas to discuss and fine-tune more or less what we were doing. But I, again, would like to emphasize that that's pretty much what came out. It was more fine-tuning. We continued to look at corporations and the large amounts of cash they have available. We continued to look at the way that we could obtain more dividends from companies that are growing their dividends, and one of our ETFs features that. And again, as Len mentioned, the market, or the emerging market bonds have a higher rate of return. So these are the kinds of tweaks that we continue to make in the portfolio. And again, we are not bearish, but we continue to be somewhat cautious. And I hope that you will continue to tune in to these quarterly sessions. I would remind you that we are on record. All of our quarterly sessions have been recorded now and are on our website. We also would suggest that you go to our website. It's been recently improved, and we think, and the results from comments from people have been very good about the new website, also about the posting of your values and things of that nature, which have all been enhanced. So until next quarter, thanks very much for tuning in.